Franklin Templeton CEO Jenny Johnson, who says the Fed has a lot more work to do to tackle inflation here, joins us now. Well, let's start there, Jenny, and it's good to have you because, we've been reporting this morning the way the bond market's looking. Many expect the Fed's going to start cutting in a number of months. Why do you see it differently?
Well, I think, first of all, I think Chairman Powell was very clear, right? He is going to address inflation. And while the headline inflation numbers were showing that they were down, you looked at core inflation, you had things, apparel, eating out, airlines, those were all higher. The claims report that came in yesterday showed that the labor market is still very tight. But you're also starting to see, some things like durable goods that show that the raising in rates indicates that it's being effective. Having said that, I think you have to separate kind of where the inflation is and then also what's the impact on the banking. We tend to think what happened in Silicon Valley Bank is more idiosyncratic and that is not a systemic problem. What will its impact be on credit and how will that slow down the economy? I think you have to remember there's been a massive increase in private credit since the GFC. Our private credit team said they've never seen deals as good as they had back with the GFC. So that will fill in somewhat. So I think our base case is that the Fed will be data driven. Right now, we'll still be on the path to even raise 25 basis points, but certainly not cut in 2023.
Yeah. I'm curious as to what you're seeing from your client base, particularly their affinity for fixed income during this period. Suddenly rates are moving down. Where are we in terms of what they're looking at and what you're kind of looking at when it comes to equities versus fixed income right now, Jenny?
So definitely we're seeing clients that they have remained very short duration, right? You get 4.5% in your money market fund. So clients have remained short. Now, those who are starting to think that we're towards the end of the cycle of the Fed raising are starting to go longer duration. But really, the majority of fixed income has still remained very short. As I mentioned in private credit, the opportunities, they think this is going to be a great vintage. So you have capital being raised there. On the equity side, again, I think people are worried about if we go into recession, you're going to want to stick to companies that have solid balance sheets, can withstand any kind of downturn with good earnings, tending to weight more a little bit towards large cap stocks. And then I do think there are folks who think that the dollar will peak at the point where rates, it tends to when rates hit their highest level. And at that point, you're going to start to see a good tailwind on currencies and opening up some investments in certain emerging markets, areas in Asia where like China has opened up. They were slower to open up post on COVID. And so you're going to start to see some economic growth there and as well as having a tailwind of currencies.
Jenny, one big number going around this morning, $5.1 trillion money market funds assets, a record high. Clearly, a lot of money has been moving in there. Can you just give us some color as to where it's coming from? Is it coming from bank deposits or is it coming from other assets and what that signals to you?
Well, I think this has been the challenge for banks, right? It's a tough situation to have rates increase so quickly. You have loan portfolios and investment portfolios that are locked in. And so banks are paying depositors 1, in some cases 0, 1, 1.5, and you can get a money market fund at 4.5% backed by U.S. government securities. So I think actually all this media attention has woken people up to that fact. So, yeah, I think that you're seeing people move from banks into money market funds.